What if I told you the market is not moving because of news, indicators, or even fundamentals, but because of one invisible force that most traders never truly understand? And that force is quietly taking money from beginners every single day. Imagine this. You enter a trade thinking the breakout is real. Everything looks perfect. The candle is strong, volume is rising, and suddenly the market snaps back, hits your stop loss, and then moves exactly in the direction you originally predicted. Frustrating, right? That's not bad luck. That's liquidity. And once you understand how liquidity actually works, you'll never look at the market the same way again. So let's break this down, not like a textbook, but like a story you can see, feel, and use. Picture a busy highway during rush hour. Cars are everywhere, moving fast, switching lanes, trying to reach their destination. But imagine if all the cars disappeared except a few. Now, if a truck tries to move through that empty road, it can easily swing left or right without resistance. That's exactly what liquidity is in the market. It's the availability of buyers and sellers. When there's high liquidity, price moves smoothly. When there's low liquidity, price moves violently. But here's the twist most people miss. The market doesn't just move where it wants, it moves where liquidity exists. Let me simplify that even more. Liquidity is basically orders, buy orders and sell orders sitting in the market. These orders act like fuel. And just like a car cannot run without fuel, the market cannot move without liquidity. Big players, banks, institutions, smart money, they don't care about indicators like RSI or MACD the way retail traders do. They care about one thing: where are the orders? Because that's where they can enter and exit large positions without getting stuck. Now imagine you're a big institution trying to buy millions of dollars worth of a stock. You can't just click buy like a retail trader. If you do that, price will shoot up instantly because there aren't enough sellers at that level. So what do? You look for areas where there are a lot of sell orders. And where do sell orders usually sit? Above resistance, above highs, and at breakout levels. That's where retail traders place their stop losses and pending orders. Now, think about this carefully. When traders place stop losses above a high, those stop losses are actually buy orders. Because if a short position gets stopped out, it means they have to buy to exit. So above a high, there is a pool of buy liquidity, and below a low, there is a pool of sell liquidity. This is the core mental model you need to understand. The market is constantly hunting for liquidity. It moves from one pool of orders to another. Let's turn this into a visual story. Imagine a crowd of people holding bags of money standing at different locations. Some are standing above a recent high, some below a recent low. The big players are like collectors. They want to gather as much money as possible. So what do? They push the market toward those crowds. When price breaks above a high, it's not always a real breakout. Sometimes it's just a liquidity grab. The market goes up, triggers all those buy orders, stop losses of sellers and breakout buyers, collects that liquidity, and then reverses. That's why fake breakouts happen, not because the market is random, but because it's engineered to access liquidity. Now, let's connect this to something you've probably experienced. Have you ever seen price consolidate in a tight range, then suddenly break out strongly, only to reverse immediately? That's called a liquidity sweep. The market builds pressure, traps traders inside the range, and then breaks out to trigger their orders. Once enough liquidity is collected, it moves in the opposite direction. It's like a fisherman casting a net, not to stay in one place, but to catch as many fish as possible before pulling back. And here's where things get really interesting. Liquidity doesn't just sit randomly, it clusters around obvious levels. Think about support and resistance. Think about trend lines. Think about equal highs and equal lows. These are not just technical patterns, they are magnets for liquidity. Because thousands of traders are looking at the same levels, placing similar orders. The market knows this, smart money knows this, and they use this predictability against retail traders. Let's take another example. Imagine a market in an uptrend. Price is making higher highs and lower lows. Retail traders are taught to buy at support and sell at resistance. So when price pulls back to a higher low, many traders buy. They place their stop loss just below that low. Now, below that low, there is a cluster of sell orders, stop losses of sellers. That's liquidity. What often happens next, price dips slightly below that low, triggers those stop losses, and then shoots up. That dip is not a random move, it's a liquidity grab. The market needed those sell orders to fuel the next move up. Without that liquidity, the move wouldn't be possible. Now let's talk about why this matters so much. If you don't understand liquidity, you will always feel like the market is against you. You'll enter trades at the worst possible moments, right when liquidity is about to be taken. You'll get stopped out just before the real move begins. But once you start thinking in terms of liquidity, everything changes. You stop chasing breakouts blindly. You stop placing obvious stop losses. You start asking a different question. Where is the liquidity and where is the market likely to go to collect it? This shift in perspective is powerful. It turns you from a reactive trader into a strategic one. Now, let's break down a simple framework you can actually use. Step 1. Identify obvious highs and lows. These are your liquidity zones. Equal highs, equal lows, previous day highs, previous day lows. These are gold mines of liquidity. Step 2. Watch how price behaves as it approaches these levels. Is it moving aggressively? Is it slowing down? Is there a buildup of consolidation? Step 3. Wait for a liquidity grab. This is usually a quick spike above a high or below a low. Step 4. Look for confirmation of reversal. This could be a strong rejection candle, a break of structure, or a shift in momentum. Step 5. Enter in the direction opposite to the liquidity grab. This is where the real move often begins.
Now, let's address a common myth. Many traders believe that the market is driven purely by supply and demand, in a simple sense. More buyers push price up, more sellers push price down. That's partially true, but it's incomplete. The market is driven by the need to match orders. Every buyer needs a seller. Every seller needs a buyer. Liquidity is what makes this matching possible. Without liquidity, large orders cannot be executed, so the market must constantly seek out areas where orders are concentrated. Another mistake traders make is thinking that high volume always means a strong move will continue. But sometimes high volume is actually a sign of distribution or accumulation. It means large players are entering or exiting positions, often using liquidity grabs to do so. So, instead of blindly trusting volume, you need to understand the context. Where is that volume happening? Is it at a key liquidity level? Is it after a breakout? Is it near a previous high or low? Context is everything. Let's go deeper into the psychology behind this. Retail traders are predictable. They are taught to follow patterns, use indicators, and place stop losses at logical levels. This creates a map of liquidity that smart money can exploit. It's not personal, it's structural. The market needs liquidity to function, and retail traders provide it. But here's the good news. Once you understand this, you can align yourself with the flow instead of fighting it. You can start thinking like smart money. Instead of being the one whose stop loss gets hit, you can be the one entering after the stop losses are taken. Now, imagine this scenario. Price is approaching a major resistance level. Everyone is watching it. Traders are placing buy orders above the resistance for a breakout, and sellers are placing stop losses above that level. There's a huge pool of buy liquidity sitting just above resistance. What does the market do? It breaks above resistance, triggers all those buy orders, and then reverses. That's a classic liquidity trap. The breakout was not the opportunity. The reversal after the liquidity grab was. This is why patience is so important. The market often gives a fake move before the real move. If you jump in too early, you become liquidity. If you wait for confirmation, you can ride the real move. Think of it like a game of chess. Every move has a purpose, every level has meaning, and liquidity is the hidden layer that connects everything. Now, let's talk about time frames. Liquidity exists on all time frames, but the higher the time frame, the more significant the liquidity. A liquidity grab on a 1-minute chart might give a small move. A liquidity grab on a daily chart can lead to a massive trend. So always be aware of the bigger picture. Where is the major liquidity on higher time frames? Is the market moving toward it? Are you trading with or against that direction? This multi-time frame awareness can dramatically improve your accuracy. Another powerful concept is inducement. This is when the market creates a false sense of direction to lure traders in before taking liquidity. For example, price might form a series of higher highs and lower lows, making it look like a strong uptrend. Traders start buying aggressively, but just before the real move down, the market pushes slightly higher, encouraging even more buyers. Then, suddenly, it drops hard, taking out all the stops. That final push up was inducement. It was designed to create liquidity. Understanding inducement helps you avoid getting trapped in these setups. Now, let's bring everything together into a clear checklist you can use every time you look at a chart. First, mark obvious liquidity levels, highs, lows, equal lows. Second, identify the current market structure. Is it trending or ranging? Third, ask yourself where the market is likely to go to collect liquidity. Fourth, wait for price to reach that level and show a liquidity grab. Fifth, look for confirmation of a shift in direction. Sixth, enter with a clear risk management plan. And finally, manage your trade as the market moves toward the next liquidity zone. This process keeps you focused and disciplined. It removes guesswork and replaces it with logic. At the end of the day, liquidity is the heartbeat of the market. It's the reason price moves, the reason trends form, and the reason traders win or lose. If you ignore it, you're trading blind. If you understand it, you gain a powerful edge. So the next time you open a chart, don't just look at candles and indicators. Look for liquidity. Ask yourself, where are the orders? Where is the market likely to go next? And most importantly, are you trading with the flow of liquidity, or are you about to become it? Like this video if it changed how you see the market. Subscribe if you want to learn real trading, not just indicators. Comment liquidity if you finally understand this concept. And remember, smart traders don't follow price, they follow liquidity.